the market is saying is that economists have it all wrong, that the focus on the unemployment rate is the wrong thing to be focused on, and that really that there wasn't much of a recovery, if any recovery at all. In fact, the Eurodollar futures curve, the U.S. Treasury curve, you look at bond curves all across the world, and they're very uniform in saying that not only has the last decade been atrocious, really, in terms of economic growth, more than that, it tells us that the next decade is starting out in much the same way. In other words, the perception of future economic growth from the long end of the bond curve is very low, which accords with a very bleak assessment of the economic baseline or economic potential. And what that does in terms of the yield curve dynamic, again, no matter what happens in the short run, the long end doesn't move. In fact, in the last few days, it's gone lower again, despite the fact that the House and Senate appear to be moving closer to passing the tax cut bill, which in traditional economic terms is supposed to be stimulus. But the bond market just basically shrugged and said, no matter what happens in the short run, the long run is essentially the same. And it's not the same as what it was pre-crisis. Again, the yield curve is pegged at a low nominal rate and nowhere near where it should be if we were actually in a recovery. And the reason is because there's a very different set of expectations about inflation and what that means, as well as the path of short-term rates and what that means. The long end of the curve is quite adamant about the fact that economic expectations and the prospects for economic opportunity in the long run from here, even after 10 years, haven't changed.